Hello, everyone. Thanks for joining us today for another session of CPS Live. We have a great lineup for you today, as usual. If you have any questions for our panelists, please enter them into the chat or the Q&A panels, and we'll get to those for you. Or if you're feeling brave, use the raise your hand tool, and I will modify your controls so you can unmute your line and ask it live. Without further ado, here is our MC, Mr. Tom Berkler.
Thank you, Lisa. You know, one of the things I enjoy most about these broadcasts is the 5 or 10 minutes we have before we even get on. As a matter of fact, they're so much fun. We're thinking of allowing all of you to expand your membership so you can tune in a little early and get in
A little
on
behind the
this.
scenes action, yeah.
Yeah, and one of the advantages for me to get on early is Lisa, who is a exemplar of good taste, tells me what, and she told me that my hair, I have a little bouffant today. Uh, so I'm going on kind of a little bedraggled. But Steve Jones, who's going to kick us off here, I said, well, let's just make it like it was intentional. Let's call it this bouffant month that we're in. The lusty month of May is bouffant month. But Steve, you were quick to say we can't do that because May's already taken. It is in fact disability income month.
It is, but we can do both if you would like.
Well, let's concentrate on DI month and look at how much time we've got left over. So talk to us, Steve.
Yeah, like we were discussing prior to May is Disability Insurance Awareness Month. It's a time for us as an industry to recognize the importance of this very integral part of any financial plan. I personally think it's a product that sometimes is misunderstood and is very undersold. Now, you probably have all heard statistics, 1 in 4 of today's 20-year-olds entering the workplace will suffer a disability lasting for longer than 90 days prior to retirement. And you're much more likely to become disabled than you are to die during your working years. And now, in keeping with our theme of today of strategies for successful selling, it's been my experience that the key to selling disability insurance, as we prefer to call it income protection coverage, is to first of all establish the need for coverage. You can know the product in and out, but as long as the client doesn't understand the need for protection, it's really not going to go anywhere. Now, I know this sounds very basic, and it is, and basic is good, but the best way to help establish this need is to have a conversation with your client and following our 3 questions that have proven to be very successful. The first question, Mr. and Mrs. Client, do you have an income protection plan in place if you were to become sick or hurt and cannot work? I think it's always good to kind of pause between these questions. So that's question number 1. Question number 2, how long could you continue to pay your bills if you were to become sick or hurt and could not work as of today? And then third, where would the money come from after that? Now, I'd venture to say that a lot of your clients, unless you're having a conversation with them, have probably never been posed those questions before, but I can guarantee you almost all of them have thought about that, from time to time. So if you're not having those conversations with your clients right now, there's no better time than right now to reach out to your client and to have those conversations. Now, remember that Tom Nichols and I, we're always here to provide you support, whether it's individual disability insurance, business overhead expense coverage for business owners, key person coverage, or disability buyout plans, and also group short long-term disability. We do have some very good customizable marketing material that you can use and that you can share with your clients. And then last but not least, we're always here. If you just don't really feel comfortable having that conversation with your client, or maybe you just don't have the time to do it, if you can make the introduction to Tom Nichols and I, we'll take it from there. We'll prepare the proposals. We'll present the plan options to your clients. We'll take the applications all the way through underwriting and to policy issue, and you'll still get paid through a commission split.
Steve, I had the good fortune to listen to a seminar by one of our carriers today on 12 common mistakes that were made regarding Social Security, 12 common beliefs. And of course, they addressed this whole question. They put up the startling figure that 40% of the retired people in the country are living solely on Social Security.
Yep.
And I jotted down the 3 questions that you ask here. That's exactly what you ought to be. You could ask somebody that's retired.
Yep.
Just, basically, where's your income? Do you have any protection plan? If something happens to that, and all you and Tom are saying there with regard to income replacement is you got to start pushing that concern back into the working life and ask those same 3 questions. Because most people suddenly were to lose Social Security, and they started with some of the startling figures that recently came out with regard to the state of the Social Security Trust Fund, the same problem would be there. So I just couldn't help but be thinking of that this is a lifelong concern here, not just something we plan for retirement on. So,
and it's much easier to have that conversation while they're still, able to qualify for disability insurance than it is to get a call. Hey, Mr. and Mrs. Broker, something just happened. What do I do now?
Yeah. The Steve, you had so much information. I don't know how much we concentrate on Bouffant month here. We've got to get over to Matt Anderson.
We'll bump that to June.
One of the other advantages that you have, if you increase the cost of your membership and tune in early, you can see me scrambling around to help get everybody jump started here with the right question. I asked Matt Anderson what he wanted me to do, and he said, just open with a round of applause. I'm reminded of the great poet Oscar Wilde, Matt, when he came through customs in America. He said, I have nothing to declare but my greatness. I kind of sense that's your state of mind. So I know everybody that's watching now is applauding to get you started as you talk to us about long-term care.
Perfect. Thank you, Tom. And yes, that is my general state of mind, I'd say. So today I thought it'd be helpful just to talk about definitions, which sounds boring, but it's a really important component of long-term care planning in general. And whatever it is that you're selling, just be aware of how the definitions work and how the policy pays out. I'd be the first to admit that I think life with LTC riders, they can be all over the board, right? And not in a bad way, but in sometimes a good way, right? In the sense that there are true LTC riders that act as true long-term care. Perfect, great to know. There are riders that don't act like long-term care, but they don't require underwriting up front. For certain circumstances, that can be important. When you're thinking about a real long-term care policy, though, inside of true LTC policies, there's different definitions of how the riders work. You've got cash benefits, which I certainly prefer if given a choice. And then you've got reimbursement benefits, which typically will reimburse you for the expenses that you are spending. What most don't realize is that even inside of the reimbursement category, there's different ways in which carriers will pay that out. For example, I kind of call it the modified reimbursement type of rider, which means that the carrier does not require you to use a licensed company to provide care. So most reimbursement policies will say you've got to go through a licensed company, and that company needs to be in the business of providing licensed care providers or non-licensed care providers, but the company needs to have that license to do that. Most policies work like that, but there is a category of reimbursement policies that say you don't need to use a licensed company, nor do you need to use a licensed individual. And they will, if you want to hire the person down the street, if you want to hire someone from church, they're completely okay with that. And they're completely okay paying that person directly, which is not quite as flexible as cash, but it's pretty close, right? The only thing that it would exclude would be direct family members. So knowing the definitions and the policies that you're talking about and offering to your clients, I think is a key component when it comes to long-term care.
Matt, you and I talk a lot about the idea of not relying on governmental aid. There's a lot of reasons for that, but you've opened up a second door here. We always say, yeah, but people want to be at home when they get their care. And that's just not an option under most Medicaid plans and under a lot of circumstances. You've taken that a step further and said, not only do they want the care at home, they want to pick who takes care of them. So it kind of opens up both those doors.
Exactly. Not only do you want to pick who takes care of you, you want to get care that's affordable, right? And so if you're
Yeah.
having to go through a licensed company to get your care provider, you run into a whole host of other issues like cycling people out every 8 hours because you're trying to avoid overtime laws. And that cost of that care is easily doubled or tripled when you're going through a licensed company, as opposed to trying to hire an individual to provide that care as a one-off. So I completely agree.
You said something that sparked my interest too. And I'm not down on the long-term care riders on life either. But you made the comment, some of them didn't require any extra underwriting. Is it reasonable to assume that if you have a long-term care rider that doesn't require any extra underwriting, maybe there's some things in the benefit definitions that might pull short a little bit so that they don't have to be that careful in their underwriting?
Yes, one, it wouldn't be a long-term care rider. It would be a quasi rider that's often
Yeah.
sold as long-term care, but it's not, right? Because there's
Yeah.
back-end underwriting. And I'm a believer of, if there's health issues that preclude you from getting a true LTC rider, that's an important pivot product, I think, to have in your repertoire. But just know how it works, right? And that's certainly better than nothing. But I wouldn't consider those riders LTC protection because they're not, right?
Yeah, and we don't want to speak too poorly of LTC riders because that'll get Matt Gandy mad, and we're kind of depending on him to fill in the remainder of the show here.
Well, and let me specify, right? Life with LTC riders, there are perfectly fine riders. It's just ranges all over the board. So it's on the agent to know what it is that they're talking about.
Yeah. Well, he doesn't look too irritated. We mentioned Oscar Wilde earlier. Of course, one of the other stories about Oscar Wilde is on his deathbed, he sat and he looked around the room and said, either that wallpaper goes or I do. Okay. And maybe Matt Gandy is that point with regard to you and me. Matt, you're going to talk to Matt Gandy. You're going to talk to thank you, Matt Anderson. We get closer and closer to this January 1, 2026 date when the law currently is going to cut in half the amount of a high net worth person's estate that they can protect from estate tax, federal estate gift tax. The window draws smaller and smaller. Talk to us about that today.
Yeah, certainly. And before we dive into that, we'll certainly echo what Matt Anderson said about the long-term care riders. There's a lot of them. Every company does them different. And here at CPS, a lot of what we do working in concert with Matt Anderson is examining those riders and seeing the different provisions inside there, doing a lot of that legwork for you. So always happy to have a conversation about the pros and cons of any of those solutions. But as you mentioned, Tom, we want to talk a little bit about taxes today in particular, as we can you see my screen?
Yep, it's up.
All right. In particular, a provision inside of the 2017 Tax Cuts and Jobs Act. This is a piece of tax code that is going to increasingly get attention as we draw closer to the election, and perhaps is even one of the key points from a decision-making process between two of the candidates, in that it's largely expected that if the Democrats win the presidency, we're going to get a reduction or the sunset in the Tax Cuts and Jobs Act. So the one that pertains mostly to our clients here as insurance professionals is this little piece of taxation with regards to estate taxes. And to understand what's going to happen, let's go back to 2017. The Trump tax cuts go into force. That doubled the amount that you were able to exclude from estate taxes. It took it from, just over 5 million per person up to 11 million per person. So you're getting double those numbers, 22 million in total if you're a married couple filing jointly. Now, the act indexed that for inflation. So today, a married couple is able to protect $27 million from their estate tax bill. And that estate tax bracket, the maximum bracket is at 40%. It's an onerous tax. Now, the big conversation is what's going to happen in 2026 if this sunset occurs. Well, the numbers that you're able to protect from estate taxes will revert to the 2017 levels and then index back for inflation. So we project that in 2026, when the sunset occurs, the final number is going to be between $6 and $8 million that you're able to protect from the estate tax. And that's per person. So about, 13-14 million dollars for a married couple. That's a huge drop in the amount that you're able to protect and plan around for this taxation. Now, it's going to do two things. It's going to, one, if you've got clients that are over that $27 million range and they do nothing, potentially exposes them right off the bat to about $5-6 million more in taxes. Moreover, if you've got clients in the middle, between that 13 or let's go individual $7 and $13 million range, they're now going to pick up that 40% tax, which can be tricky to plan for. Now, there is some good news. The IRS has done us a favor in this case and given us some clarity with regards to the way that this sunset is going to happen and what's going to happen to these higher lifetime exemptions that we have available now. Well, they've said, hey, it's a use it or lose it. We are not going to go back and claw these higher lifetime gifts if a client chooses to use them during this time period. So that gives us a really limited window at this point to go ahead and do some very nice planning for clients. I always like to couch it in this. There's really a few ways that you can pay the state tax or estate tax, or a few ways that clients actually do. One, if you've got enough liquidity, they'll pay for those taxes using cash. Number two, they'll try to sell assets. So particularly real estate heavy clients here in Orange County say, well, we'll sell the apartment building or the houses, etc. Well, that may work. You've got to keep in mind you have 9 months to pay these taxes. So you would need to liquidate these complex portfolios very quickly. We also see families borrowing funds, obviously introducing a bank, interest rates, collateral, etc., into the situation. Last, and perhaps most commonly for us as insurance professionals, people will use life insurance because it gives us that liquidity and leverage at just the time that you need it when someone's passed. So that's a little recap on what's going to happen in 2026 as it is now. It's definitely something that's going to be talked about because there are other provisions in the Tax Cuts and Jobs Act that are slated to sunset. Tom Berkler, myself, or anyone on the life insurance team are happy to hop on the phone with you, your clients' attorneys, CPAs, etc. Have conversations and even expound a little bit on some of those strategies that we're using to solve this.
Matt, you and I, we talk to a lot of clients and impress upon them that this isn't something, if you're going to take advantage of these high exemptions, you can wait until you're ready to toast in the new year on 2026 and start moving money. It takes time to do the planning. Usually a trust attorneys are going to be swamped. So they need to get moving now. And I got from a person we work with regularly at one of our CPS offices who says he's surprised by the number of clients that don't get moving because their tax and legal advisors are saying they'll probably extend the high exemptions. I don't see that anywhere. I don't know that I'm as optimistic as you are that if the Republicans get in, they'll do it.
Yeah.
But you and I just want a quick throw out. Maybe we can elaborate on this another week. But one of the advantages you've got is go ahead and take the amount of money that would take advantage of the high exemptions and loan it to the trust. And then as you're getting into December of 2025, and it's pretty clear that the sunset's going to occur, turn it into a gift, just forgive the loan. But if it
Yeah.
looks like everybody's hale and hearty and can extend it, then draw the money back, call the loan. So there's options here that are very low risk.
Exactly. I'd say this, don't put it in Congress's hands, whether or not you're going to be exposed to this or not. We've got tons of very flexible planning strategies that we can use to manage your way around this. So it's a perfect time to talk to your clients about this. As you say, Tom, this is not something you can wait till the last minute for. We were just working with a client's attorney. This is a few weeks ago now, and he did a nice job. And we asked him, "Hey, will you take referrals if we bounce into anyone?" He said, "Nope, I will not take any referrals before 2026. I am
Yeah.
booked."
Yeah.
And that was shocking to me, but definitely something to keep in mind.
Yeah. Yeah. That's I had a thought, but I was so taken with what you were saying, it kind of got pushed off to the side there. But we will run the calculations quickly to let people know how hard they're going to be hammered and how much harder they're going to be hammered when that 1/1/26 date comes along. So that's good. We'll keep this in mind. Lisa, do we have any questions coming in the box here?
As usual, you guys are so thorough. No questions came in.
Yeah. Oh, just the diplomacy is overwhelming, Lisa.
Yeah.
Matt, you kind of closed with the fact that we shouldn't leave our estate planning in Congress's hands. Can you please tell us what you suggest we do leave in Congress's hands?
I'll defer to Rob Reedy next time he's on. He can talk about that.
Lisa, the gentleman. Thank you, Lisa. Thank you. Take us out of here, Lisa.
All right. Thanks for joining us today, folks. If you have any questions, contact information is in the chat, and we hope to see you next time.
Thank you.
Thanks, guys.